Have you noticed lately that when you go to the bank for a mortgage or a car loan, the interest rates are lower? And when you put money in a fixed term deposit, you earn less interest. That's what we call an interest rate cut. Many people think an interest rate cut is only about the government and banks and has nothing to do with ordinary people like you. That's completely wrong. An interest rate cut is like putting money for the whole economy on sale. It affects everything: your monthly mortgage payment, how much interest you earn on savings, installment plans for cars or phones, even jobs and prices. In the next few minutes, I'll explain in plain English exactly how an interest rate cut helps or hurts you. By the end, you'll know whether you should save, borrow, or spend. Let's skip the complicated jargon. Here's a simple idea. Think of interest as rent for money. When you take a mortgage or car loan, you're renting money from the bank, and interest is the rent you pay. When you deposit money in the bank, you're renting your money to the bank, and the interest you get is the rent they pay you. So, what is an interest rate cut? Simple. The government lowers the overall rent for money. That gives you two clear facts. Rent for borrowing money gets cheaper. Rent for saving money gets lower. One sentence to remember. Interest rate cut equals cheaper loans, lower savings interest. Everything else comes from this. Who benefits the most? People with loans, mortgages, car loans, credit card installments, consumer loans. All get cheaper, especially mortgages. Take a common example. A $1 million mortgage over 30 years, with equal monthly payments. Before the cut, 4.3% interest, you pay about $5,015 a month. After the cut, 3.8% interest, you pay about $4,670 a month. That's $345 less every month. Over $4,140 a year, and more than $120,000 total in 30 years. Car loans, credit card installments, renovation loans, all follow the same logic. If you owe the bank money, an interest rate cut lowers your monthly burden. On the other side, people who save money will earn less interest. Example, $100,000 in a one-year fixed deposit. Before, 2% annual rate, you earn $2,000. After 1.5% annual rate, you earn $1,500. That's $500 less per year. Money market funds, government bonds, and other low-risk products also earn less. Your passive income drops a little, but your principal is still safe. Saving is still stable. You just can't expect high returns from it anymore. An interest rate cut also affects daily life in many big ways. Cheaper consumption. Stores and car companies offer interest-free or low-rate installments. Phones, home appliances, cars, big purchases cost less. More jobs. Companies can borrow cheaply, so they expand and hire more people. It becomes easier to find or change a job. Mild price increases. More money flows in the economy, so prices rise gently. The government controls this, so no sudden spikes. More stable housing market. Lower mortgage rates mean more buyers. Home prices stay stable or rise slowly. If you're buying a home to live in, your cost goes down. Now, two practical tips you can use right away for savers. Don't lock all your money in long-term fixed deposits. Keep some cash for emergencies, some in short-term deposits, and a small part in low-risk investments. Stay away from high-risk products. For buyers, home buyers, and small business owners, if you really need a home, car, or equipment, go for it. Lower rates help. But don't borrow blindly just because rates are low. Only spend what you can pay back. To wrap it up, an interest rate cut eases pressure on borrowers, lowers income for savers, and energizes the economy. The smart choice is to go with the flow. Stay calm about debt. Don't chase unrealistic returns on savings, and spend wisely. Now you understand how rate cuts affect you. No confusing jargon. If this was helpful, please like and subscribe. Next time we'll talk about interest rate hikes and how to prepare early. That's all for today. See you next time.